Welcome to the Skilled MBA Finance Case Study Series, where we decode strategic financial decisions shaping the corporate landscape. ITC Limited, a diversified Indian conglomerate, initiated a landmark demerger to separate its hotel business into a new independent entity. The move is a strategic step toward unlocking value, enhancing transparency, and improving capital allocation. Under the demerger structure, existing shareholders will receive proportional ownership in the new hotel company, ensuring continuity and fairness. This bold decision is rooted in ITC's long-term strategy to streamline operations, enable focused leadership, and foster sector-specific growth, especially as the hospitality business demands unique capital and operational frameworks. By unbundling its conglomerate model, ITC aims to improve operational efficiency, drive investor confidence, and enhance shareholder returns. The demerger structure involves separating ITC's hotel division into a standalone entity. This plan outlines the mechanics of ownership distribution, ensuring shareholders receive proportional shares in the new entity. The goal is to unlock value by allowing focused management and strategic growth in the luxury hotel segment while maintaining ITC's diversified business model. Founded in 1910, ITC Limited has transformed from a tobacco company into a diversified conglomerate. Its business segments include fast-moving consumer goods, luxury hotels, paperboards and packaging, agribusiness, and information technology. Despite diversification, ITC's revenue heavily relies on its cigarette business. With a market capitalization exceeding 5,35,000 crore rupees, ITC remains a significant player in India's corporate landscape. On July 24, 2023, ITC Limited announced the demerger of its hotel business into ITC Hotels Limited. This decision followed investor pressure to address the conglomerate discount, affecting ITC's valuation. Despite contributing only 5% to revenue, the hotel segment demanded substantial capital, highlighting the tension between growth and shareholder returns. This restructuring could influence other diversified companies. ITC Limited retains a 40% stake in ITC Hotels Limited, ensuring strategic influence while providing brand licensing and operational support. Existing shareholders receive 60% ownership in the new entity, gaining direct exposure to its performance. The demerger is executed via a court-approved scheme, aligning share distribution with current ITC holdings. ITC Hotels boasts over 120 hotels in 70-plus destinations, featuring premium brands like ITC Maurya and ITC Grand Chola. Known for sustainability and strong food and beverage reputation, it reported 2,172 crores in revenue and 505 crores earnings before interest, taxes, depreciation, and amortization in fiscal year 2023. Despite post-pandemic recovery, the asset-heavy model demands significant capital for expansion amid cyclical challenges. The market's reaction to ITC's demerger announcement was underwhelming, with the stock dropping around 8% in the following week. This decline indicates skepticism about the demerger structure and strategic rationale, despite the anticipated value unlock. Investors seem cautious about the potential benefits and execution of this strategic move. Management envisions focused growth with a dedicated team for the hotel business, enhancing industry-specific decision-making. A separate listing clarifies valuation, reducing conglomerate discount. Shareholders gain direct exposure to hotel dynamics, allowing flexible investment. As an independent entity, the hotel business can pursue strategic partnerships and growth initiatives more efficiently. Investors are concerned about the partial demerger, questioning the retention of 40% ownership. This raises doubts about confidence in the hotel's independence. Capital allocation is another worry, as significant infusion might limit returns. Governance ambiguity with dual ownership could lead to conflicts. Analysts also question the timing, as the industry recovers from pandemic impacts, complicating initial valuation. Analyzing the shareholder dilemma involves evaluating the sum of parts valuation impact and independent growth trajectory. Governance evaluation focuses on board composition, related party transactions, and minority shareholder protection. Strategic alignment examines brand licensing, operational independence, and capital allocation autonomy. Proxy advisory firms are split, with some endorsing the demerger for value creation, while others question the partial ownership structure. Examining past demergers, Reliance Industries' complete separation of geofinancial services saw positive initial reception. Larsen & Toubro's majority ownership in Larsen & Toubro Infotech led to strong value creation. Grasim Industries' partial demerger of Aditya Birla Capital raised governance questions, while Piramal Enterprises' partial demerger of Piramal Pharma initially underperformed. Clear governance and strategic independence are crucial for success. Post-demerger, ITC Limited can allocate less capital to its hotel business, enhancing return on capital employed and return on equity, and focus on expanding its fast-moving consumer goods segment, possibly increasing dividends. ITC Hotels gains independence in capital raising, strategic partnerships, and growth flexibility, with potential valuation multiples of 15 to 18 times enterprise value or earnings before interest, taxes, depreciation, and amortization, unlocking 15,000 to 20,000 crores in enterprise value. The structure of a demerger is crucial, influencing ownership, governance, and operational independence, which affect market perception and success. Market signaling is vital. Partial demergers may imply doubts about the new entity's viability. Timing is key. Demerging during recovery can hinder valuation. Clear governance and minority protections boost market confidence. The ITC demerger highlights a potential trend in Indian corporate restructuring. Diversified conglomerates may pursue similar paths to unlock value. Family-owned businesses could use this as a model for succession planning. Multinational corporations might reassess their Indian operations. Private equity investors may find new opportunities in facilitating business separations. Demergers can unlock hidden value, but require precise structuring and governance. Aligning corporate restructuring with shareholder interests through transparent rationale is crucial. Execution details significantly impact market reception and long-term success. Thank you for exploring this financial transformation with us. For more insights on corporate strategy and finance, connect with us. Mobile +91 87553 00795. Mail support@skilledmba.com. Website www.skilledmba.com.